Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I am Paul Winkler, and he is Evan Barnard. No lip syncing. I gotta know that. You gotta really talk.
There you go.
Oh my goodness.
Investment mime won't work on the radio?
No, it doesn't. It makes terrible radio. All right, so Stort says no to any audio. So forget it. I'm not going to do what I was going to do. So I apologize. Hey, I know how to switch. I'm a professional. I can switch gears like nobody's business. Okay, so I think an area to start. Well, actually, there's a couple things. I got a text message today from none other than Dan Mandis.
Excellent.
And asking a question, something that he saw on, Lord only knows where he saw this, but anyway, it was, you've probably seen this, Evan, Investing Expert. Is saying that the U.S. super bubble will pop soon.
Super bubble?
Super bubble.
That's a new one.
It's a bubble with an S. A big S on the front.
Uh-huh.
And when it pops, man, you know.
There's probably a Bitcoin logo built into the bottom of that thing or something.
Have you been watching that? That will be
there's
a topic.
Your super bubble.
Trust me, we will talk about that today. Okay, so I've seen it several places. I've gotten it from several different people. You know, hey, Paul, see this thing about super bubble? What do you think? And I said, yep, seen it. Many times over the past 20, 30 years, I guess I've seen that. It's funny. You see that kind of stuff quite often. But, here is my thoughts regarding super bubble, blah, 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 whatever you want to call it. And it's very related to another question that I had as well that somebody gave me. May use it in a different segment because it kind of gets into a long topic on something I haven't talked about in quite a while. But number one, I think whenever you see this kind of stuff, that there's a super bubble. Mm-hmm. That it starts laughing because I can't say super bubble. So it always begs questions for me.
Uh-huh.
And number one is, okay, which market is in the super bubble?
Sure.
So which market? Is it large companies? Is it small companies? Is it large? No, it's always just the market is in a super bubble, and that's, period, end of sentence. There's nothing else to it than that. But of course, as you know, if you are a regular listener to this show, you know that there are many markets as an investor that you ought to be thinking about. You got large companies, you got small companies, and value and growth, and international and U.S. and of course, then there's fixed income, but that's not typically what they're talking about when it comes to this stuff. If we look there, I knew I had something here. I was like looking through these papers that I had printed just before the start of the show. The S&P 500.
Uh-huh.
Right now selling for about 21 times earnings.
Okay.
Super bubble to me might be it's at 40 times earnings. Now, typically what you're hearing them talk about when they talk about bubble or super bubble is, what's the PE ratio sitting at? And if you were to look at the PE ratio in comparison to historic norms, if you are looking at backward-looking earnings,
right,
what the earnings were over the last year,
mm-hmm.
You would say, well, wait a minute. Yeah, earnings kind of stunk over the last year.
Sure.
So if the denominator, which is earnings, is low, that's going to automatically make the numerator look high. So first flaw with that is they're typically looking at that. They're not looking at forward earnings. In other words, you have analysts, you have people going and visiting companies, you have the companies themselves giving guidance, as we call it, giving us some kind of an idea of what earnings are going to likely be in the future, and then commensurate with all that public data and all that information is best as people can figure it out, they determine what price am I willing to pay for these stocks.
Sure.
And right now it's 21, which is a little bit high compared to historic norms, but that just makes the earnings yield 5%. In other words, I pay a certain price for every dollar of earnings, and it's usually I pay $16 for every $1 of earnings. So your earnings yield is usually 6.25%, and now it's 5. So number one, that's the first bad thing. You're looking at only one area of the market, and yes, it is a little higher than normal, but it's not like outlandishly high. And if you look at other areas of the market, like for example, if you look at the next highest area of the market, and what do you think the next highest area of the market is?
Oh gosh,
from a price to earnings. This is not an easy question.
Small growth.
Actually, believe it or not, well, you're not bad, but it is actually international.
Large?
International large, yeah.
That is surprising.
Yeah, at 1382. Yeah,
okay.
I was surprised as well. Small cap international was the next, that was really surprising to me, which is at 1368. Small U.S. is next, 1362. They're all in the same area, but that's not extraordinarily high by any stretch of the imagination. You take a dollar divided by that number, and that gives you your earnings yield. So if earnings just keep going on as expected, I get $1 of earnings this year, $1 next year, $1, and let's say we're talking about a big company, $13 billion company. I get $1 billion of earnings, $1 billion, $1 billion. That's my earnings yield. Just like your yield on a bond would be your interest rate. And if I've got a $1,000 bond and it's got a $30 interest payment, then that's a 3% yield. Okay, so it's the same basic thing. Don't let it confuse you too much. It's not that bad. Microcap stocks about 1284. And if we look at large value, it's about 1241. Then we get down to emerging markets, about 1164. And emerging markets value, it's about actually U.S. value is about 11. That's it, 11.
Okay.
And historic norm is about 10. So big deal. Not to be excited about. That doesn't mean the stocks can't go down. They can. I mean, the stocks go up 3 out of 4 years, and they go down 1 out of 4, and that's about the way it works, right? Small value is only $9.99. That sounds like a commercial. You can get a small value stock for $9.99.
But you have to act now.
You took the words out of my mouth. International value, $8.84. So about just shy of $9, right? Small or international emerging markets value, $8.44. And then you've got emerging markets, $7. You get lowest. Emerging markets value is $7. Mm-hmm. It is international small value at $8.84. So you look at that and go, what's the bubble? Number one. So which market is the first question you ask? Now, typically people only look at large U.S. stocks because you look at companies like, a really good article about Vanguard. Did you see the article on Vanguard today?
I did not. I was actually doing a lot of crypto work reading
Were
today.
You? Okay, so we'll hit that. We will definitely, but the Vanguard, oh boy, people are hot. They're upset. Really upset.
Oh.
Yeah. I'll have to clue you guys in on what's going on there. They have, we'll get to that. So I look at how much of our portfolio. Those big fund companies like Vanguard and Fidelity have like 90% of people's money in that. If you take all the assets they manage and put in the numerator the amount they have in large growth and large blend, it works out to about 90%. So number one, if we look at that, what do we have? Like less than 10%, typically what I would recommend in that asset category.
Right.
So I wouldn't have that much there in the area that is supposedly wildly overvalued, which is not wildly overvalued. It's just a little higher than historically normal. But what happens when I'm out there and I'm an investment guy that wants everybody to tune in to my stuff? What do? I wait for the market to come down for a week.
Yeah.
Right? For a week it comes down, and then I go, the market's wildly overvalued. And I look credible all of a sudden because what I'm seeing in the news that the market's down is what I'm seeing in my portfolio. Oh my goodness, this person must be right. They must be somebody that I should be listening to.
Yeah. And I think they assume, and maybe they just forget too. Well, they're scumbags, but let's be honest. But when the thing that gets me when I was looking at some of those throughout the week, looking online at various headlines, what got me was market's worst performance since October.
I know. Like
we haven't been this horrible since June of 2021. Okay, it's not the .com bubble. It's not the depression. It's 6 months ago when it was a new high back then.
We're in a bear. We're in a correction for the Nasdaq. How much? 10%. Oh, yeah. Oh, that happens once a year.
Yeah.
Historically, on average, for 100 years, that happens once a year. So that's news. Why?
Yeah.
Something that happens that often. Yeah, it's silly. So you think about why do we diversify? Well, international. I was telling Dan, I said, international has not gone through the recovery. Now, this isn't, hey, guys, now let's go and load up on international type of a conversation. But think about it. International has not gone through the recovery that the U.S. has.
Right.
Because they're still kind of in hiding. But there was news Friday, and it's trickling out, and it's just interesting. Just watch it. I don't know. But just watch. They are... What do they call it? An endemic? You have pandemic. Is when everybody is, going and hiding. An endemic is kind of like, okay, this is with us to stay.
The flu.
And we can just, it's the flu, and we can just go, this is kind of what happens from time to time, and it's going to happen from time to time from here on out. Let's get used to it. Let's, deal with it.
Yeah.
That's actually what a lot of countries around the world are actually moving to.
UK is moving big on Monday for that, or on the 26th, I guess, technically.
Yeah, so, that if you see these markets start to open up and people start to go out shopping again, and you have this built-up demand that is going to be unleashed, kind of like it was in the United States, I was going, what kind of implications? I'm not going to try to predict it or anything like that, but I'm just saying, that my point is going and hiding my head in fear and worry is just kind of silly when you look at some of the things that are going on around the world.
And one thing to point out is, as you were kind of alluding to at the very start of this session, was the market is largely a leading indicator of economic performance and so forth. And we don't predict, but if we have a case where investors are bidding up the price, they're not stupid. They're expecting an increase in earnings.
Right.
So they're expecting things to do well, and yet the media treats this as, it's overheated, it's going to crash, but it's reflecting a very positive sentiment for investors across the board.
Yeah, and there's a great example of that I'll bring out today. That is just a phenomenal example of that very aspect of markets and how they're leading.
Right.
How they lead. Yeah, there's a stock trade that happened this week, or a stock movement that happened this week, that is just an absolutely brilliant example of just what you just said. So, that'll be something I get to. Now, if you look at this and you go, so, well, why would these people give us this information, right? Why are they telling us that the market's going to go down?
Yeah.
Wouldn't they profit more by keeping it from themselves? Why are they telling us it's going to go down? And why do they do it only after markets go down some? We've already talked about that, but could it be that they benefit from creating fear? Could it be that they benefit from getting people to get their money in motion? Start to move your money. Hey, this is what's going on. This is a bubble that's coming. You need to get out. Oh, what? Well, who benefits when you trade stocks? Wall Street does. Who benefits when you buy whatever it is that you're going to move to? Wall Street does. Or they may be going, hey, let's get people all scared about a bubble because, man, I kind of missed this big upturn in the market.
Yeah.
And I hate it that I missed this big upturn. And if we get the market to come down again, then I could get in and then, at a little bit better price, and I won't feel so bad about myself and feel so terrible because the FOMO has hit me.
Right.
Right? So They do. And that tends to happen. Now, could it be that simply trying to drive up that buying and selling activity? But you think about this, who buys and sells stocks on a daily basis? And who is the market maker for the securities that we see traded on Wall Street? People that do nothing but trade Amazon all day long, do nothing but buy and sell Apple all day long, do nothing but buy and sell Walmart all day long. And when they are basically buying a stock from somebody that says, market's in a bubble, well, are they just blooming idiots that are saying, I can't wait to pay a price that's really, really high just before it just crashes?
Right.
No, they're not. They're not blooming idiots, and they're big institutional investors. And, why would they buy at those levels? And, the other thing to think about it is if these stinking, and it's always professional, Wall Street professional says there's a bubble. If these people are so brilliant and so stinking good at figuring out where markets are going, why is it that 93% of them over 15 years of professional investment managers can't beat what the market did on its own? They should trounce it. 97% for small cap managers. They should be killing it. They should be having unbelievable, and the 7% that beat, or the 3% when it comes to small caps, what you expect through blind random luck.
Less than what you would expect through blind random luck.
Well, that's true. I mean, yeah, it technically is true because you got the expenses that they've got. They've got the hurdle rate, as we call it.
You'd think it'd be half.
Yeah, the hurdle rate is, you have to overcome the expenses. So, as Evan's saying, technically it is. It's less than what you'd expect until you. Yeah. So it's just the same stuff all the time, trying to predict the future. Because if they can get it, if they can just get out there and they get their 15 minutes of fame or whatever it is that they're looking for, then it's like Andy Kessler wrote the book Wall Street Meat. And, yeah, great name for a book, right? And he writes this book about being a trader, and he's talking about the conflicts of interest on Wall Street, and he's going through all this stuff, and he's Mary Meeker and Frank Quattrone and all of these people, and he's talking about what's going. And he says, most brilliant line in the book. He says, if you want to be famous, if you want to be put on a pedestal as a Wall Street analyst, analyzing these companies and determining what their future direction is and all of that, you just need to be right more than 50% of the time.
Yeah.
That's it. And it's not a high bar.
Right.
You need to be right 90% of the time. No, that's not what he said. He said you just need to be right more than 50% of the time.
Yeah.
So you're famous if you're 51%, you're nobody if you're 49. It sounds like a horse race.
Sounds like Congress.
That's a whole different topic.